Hello, tutor. Today we will introduce how we do for the project 2. The first question is that what are the known and or native hypotheses that the project 2 is testing? Firstly, known hypothesis, we assume that the average volatility of the long and short portfolio is zero. That is not statistically significant volatility. And then alternative hypothesis assume that the average volatility of the short portfolio is non-zero. There is statistically significant volatility. And the next question is, what's the methodology of the portfolio construction and how is it implied in Project 2 code base? The methodology of portfolio construction is long-short portfolio. It achieves profits and hedge risks from the rising and falling markets by holding both long and short positions. In this strategy, investors go long when they think the stock price will show an upward trend, and they go short when they think the short price will show a downward trend. This strategy not only relies on the risk of stocks to make profits, but can also make profits on the decline. The purpose is to achieve more stable returns and reduce investment risk. And how it implements in Project 2. Step 1, ETL. The main purpose of this step is to extract data, transform this data to meet and analyze needs, and finally put them in a centralized system for analysis. Firstly, use the read PIC-CSY function to extract the address closing price of the specific stock code within the defined date range from the CSV file of stock price information and organizing it into a pandas sequence. And then use the daily return code function to calculate the daily return from the read price information. Thirdly, use the monthly return code function to calculate monthly return from the price information. Finally, use the AI return date function to summarize the prior two report results into a dictionary. And the next part.
Step 2 is calculate volatility. This step is calculated by analyzing the stock's past price movements based on past daily closing prices and may be adjusted for annualized volatility if necessary. The VOL call function when the parameter chart name is set to VOL will use the standard deviation of the daily closing price in the ETL results to calculate the monthly volatility. Then merge the monthly volatility and monthly return calculated in the previous step through merge tables. Organize into a table to facilitate portfolio constructions. Next page, please. Step 3 is build a long-short portfolio. A long-short portfolio is constructed by going long stocks in the last quartile and short stocks in the first quartile each month. Stock ranking. The method is to divide stocks into Q quantiles. Each stock is assigned a ranking based on quantile in which its characteristic value falls. This step is implemented in the code through stock sorting. Construct IS portfolio. Based on the monthly return, go long the stock in the last quantile and short the stock in the first quantile each month. To build an IS portfolio, the monthly return of IS portfolio is calculated by the PF call function. Next, please. The third question is, what inferences can we draw from the output of part 9? IS bar is the average of long-short portfolio fluctuation values, representing the degree of portfolio risk control. The parameter setting of chart name is VOL, so the calculation result is volatility, not return rate. This result shows that the average volatility is small, indicating that the portfolio risk is under certain control. And IST is a calculation result of the T statistic value in the test hypothesis. If the T statistic value is greater than positive 1.96 or less than negative 1.96, the null hypothesis is rejected and there is a statistically significant difference. It shows that the volatility has changed significantly and there are risks. If the T statistic value is between negative 1.96 and positive 1.96, there is insufficient evidence to reject the null hypothesis, and there is no significant difference. It shows that there is no significant change in volatility and no risk is detected. The result shows that T is between negative 1.69 and positive 1.96, indicating that there is no significant change in volatility and no risk is detected.
So the fourth question is, do you think the results are reliable? Why or why not? The answer will be no. Volatility is indeed a key metric in risk assessment, but it does not fully capture all types of risk. In addition to volatility, there are many other factors that can affect a portfolio's overall risk level. For example, credit risk refers to the risk that the debtor or issuer cannot pay its debts on time or defaults on its debts. Assets such as bonds and credit derivatives included in the investment portfolio may be affected by credit risk. Liquidity risk refers to the risk that certain assets cannot be quickly realized in the market at a reasonable price. When market liquidity decreases, investors may face greater transaction costs or be unable to adjust position in a timely manner. Operational risk refers to the risk of loss caused by factors such as operational errors, technical failures, poor internal controls, etc. Pure operational management can result in portfolio losses or adverse trade executions. Market systematic risk. Even a portfolio with low volatility may be affected by directional changes in the overall market. For example, macroeconomic factors, policy changes, geopolitical events, etc., may cause the entire market to decline, thereby affecting the value of the investment portfolio. Therefore, effective risk management requires comprehensive consideration of various types of risk factors, not just volatility. Investors and asset managers need to ensure the robustness and risk resistance of investment portfolios through multi-dimensional risk analysis and monitoring. Next one.
The fifth question, is there any further work you would like to pursue based on Project 2? I think there may be 4 things we would like to pursue. The first one is diversified investment. We can diversify our funds into different asset classes, such as stocks, bonds, real estate, and commodities, or choose stocks in different industries in the stock market, or invest in different geographical areas. globally. This way, even if one asset class or industry is adversely affected, the rest of the portfolio still provides a level of protection, reducing overall risk. The second one is risk measurement and analysis. Quantity volatility through indicators such as standard deviation, variance, covariance, and correlation coefficients, and analyze the risk characteristics of each asset to determine its contribution to overall risk. This helps us identify and manage potential risks, optimize asset allocation, and achieve investment goals. The third one is risk control. By implementing measures such as stop loss, orders, and hedging strategies, we can limit potential losses and protect our portfolios from excessive risk. This helps maintain portfolio soundness, protect capital, and improve overall investment performance. The fourth one is monitoring and adjustment. Regular review of the performance and risk profile of the investment portfolio, as well as market changes and adjustments to investment objectives, can help to detect and respond to potential risks in a timely manner. Thank you.